Everybody is on one side about this being the year of two halves. And, like, I don't know if it's time to change yet, because here's the thing with inflation. If you look at the inflation report this week, you saw that the headline inflation is coming down. And yeah, I think Professor Siegel is right that if we continue to get a 0.1% decline in month-over-month inflation, that we are actually on the path to 2% year-over-year inflation by the middle of this year. So that's great news. But here's the thing. The Fed is looking at the core inflation, which still rose 0.3% month over month. And if you project that out, then we're still on the pace of 4% year-over-year inflation by the middle of this year. So not quite on pace to 2%. And by the way, shelter was still rising 0.8% month over month. So I do worry that the Fed is going to look at that and say, look, the markets may be pricing in one thing, but the core is where we focused on, and that's just not good enough. Oh, and by the way, financial conditions are easing across the board, and that's something the Fed has sort of told us again and again they don't want to see. So that's why, and by the way, Scott, you also look at the Fed funds rate, and now 5% is not even in there anymore. It's just shy of 5%. So I think the Fed looks at all of that and says, well, maybe we need to reset the expectations.
Well, the bond market is clearly saying the Fed is wrong. The Fed is trying to go out of its way to suggest that the market's wrong. These two forces are eventually going to meet somewhere, and then maybe that's the decider as to where stocks go from here. Because what's going to happen if it turns out that the Fed actually is right. The 2 year's not going to be where it is. It's going to shoot higher, and the stock market's not going to be where it is. It's going to shoot lower. But who wins this fight?
I think you're right. The 2 year does have to move higher because we have priced out the 5% rate that the Fed has told us sort of again and again they're trying to get to, even north of 5% and hold it there. So it is a bit of a mystery why we're backing off that 5% just because we're seeing some easing in headline inflation. So I think that part of the curve definitely needs to go up. But if you look at the longer part of the curve, I think the moves there may be somewhat justified because inflation over the next 6 months to 12 months is set to ease. And the Fed is set to pause, and we're not going to see much in terms of growth this year. In fact, we might see some decline in economic growth. So that's what the 10-year is starting to account for. So I think that move is justified, but the front end of the curve likely needs to come up.
Why does it have to go up? Why does it have to go up, though? I mean, if growth is hanging in there, okay, and inflation is falling perhaps faster, as some would suggest, like Dr. Siegel, then the Fed is willing to at least acknowledge now. I get the whole jawboning game. But what if inflation's coming down fast enough, the economy's holding up better than many people thought? We actually can engineer a soft landing. And that doesn't mean that the Fed has to go as far as some have thought.
Well, here's the question. Are we talking about the next month or are we talking about the next 6 months? If we're talking about the next month, I don't think we have enough data for the Fed to say this is it. Inflation has convincingly come down. I mean, they use this sentence. They need substantial, significant evidence to see that inflation is on the right trajectory. Year over year wage growth is still 4.6%. It's better than it was, but it's still 4.6%. And again, core inflation is not on the path to 2%. So over the course of the next month, I don't think that's enough for the Fed to say they have the evidence. Now, over the course of the next 6 months, I do agree that I think we will have enough evidence because, Scott, all the layoffs that are happening, most of them in tech, I think that is dampening the sentiment, and it's sort of reshuffling what employers are willing to pay people and what employees are willing to accept. So all things equal, even if we don't see a huge spike in the unemployment rate, I think we will start to see that wage growth gradually come down. But that's not a 1 month thing. It is likely a 3 to 6 month thing. And that's why, yes, it is consensus, but I would still stick with the outlook that at least in the first quarter, we're going to have this, battle between the factors of inflation and the Fed and just the reality of slower growth.